Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. What's up, guys? Another huge week in the markets. Everything is shitting the bed. Year to date, S&P is down 22.53%. NASDAQ down 30.75%. Russell down 24.79%. And the Dow is down 18.57%. It's now our regime system is at a 67% chance of risk off. Stagflation and deflationary odds skyrocketed this week. It's looking like there's no end in sight with this stagflation regime.
No, certainly not, especially given now that we pretty much saw the system strength double in the last week. So we were sitting around 18%. Now we're above 40%, which is just more confirmation that the current regime is picking up strength again and likely will remain sticky. Let's go to the economic calendar.
So Monday, we've got a bunch of Fed speakers. Tuesday, we've got durable goods orders, Case-Shiller home price index, consumer confidence, and new home sales. And then we also have a bunch of Fed speakers. Wednesday, we've got international trade and goods, pending home sales index, and EIA petroleum status report. We also have more Fed speakers on Wednesday. Thursday, we've got GDP, jobless claims, EIA natural gas report, and the Fed balance sheet. Still have a few more Fed speakers. And Friday, we've got personal income and outlays, Chicago PMI, consumer sentiment, and two more Fed speakers.
Yeah, so let's go over the recap of what happened last week. We had building permits come in, obviously ticking lower. Now both printing negative territory month over month and year over year. We have the year over year figure accelerating to negative 14%. So obviously the housing market is starting to see some type of slowing. We had the housing starts accelerate. On the other hand, we had them come up to 1.57 million. The month over month figure accelerate 12%, but the year over year figure remains negative. Something to watch. Once we see that year over year figure start picking back up and holding positive territory, obviously there's more indications that new houses are starting to be or breaking ground. Existing home sales falling like a rock. Obviously, we've been watching this closely. We have both month over month, year over year figures still in negative territory. So year over year figures now almost negative 20% on new home sales. Long story short, higher interest rates are not good for housing. But again, we all knew that. We have the United States crude oil stocks shifting or closing positive again this last week, printing in positive territory. We have crude oil well off the highs seen in July or late June. And remember, as we said, crude oil stocks, the more frequent positive prints, the more stressful it is on the price. The more frequent negative prints, the more boost the price gets. So just watch this, see where the prints are coming in. Obviously, if the prints are frequently negative, it's just more upward pricing pressure. We're starting to see more and more positive prints, which is putting more and more weight on the price of crude. But as you know, as we said at the beginning, stagflation is not over yet. So we can't just get all giddy to short energy or say that commodities have peaked, because again, we have to follow the regime, and we'll go more into our strategy in a few minutes. Initial jobless claims. This is a monthly chart to accurately represent the year over year and month over month changes. We are still up 43.35% year over year. Excuse me, we're down 43.35% year over year. We are still down, and we're still down 6.58% month over month. So obviously, there is no stress in the jobless claims just yet. Labor market remains tight, something we're watching going forward, but no signs of any boom, or I should say, rapid rise in unemployment so far. We had manufacturing PMI come in at 51.8. So we're hovering just around that 50 mark, well off the highs from earlier this year still, but not really falling down. Something to watch. Manufacturing remains in a what we would call above average rate at this point in time. Service PMI coming back up to 49.2. We were seeing low 44s the last two prints, still under 50, signaling a contraction. Not really, we haven't really gotten above that 50 mark yet. And the prints are still well off their early year highs. Global composite PMI actually ticking lower. So this out of the three PMIs, this is ticking lower and well off the early year highs, well under 50. So we're sitting low 40. So obviously there is a global PMI contraction between manufacturing and services, which again, that's, you can just look at the market and see that that's not really too surprising. Now, big update in the last week, we had the FOMC meeting. After the FOMC meeting, a lot of things changed. Number one, the terminal went up. Number two, in lieu of the terminal going up, we're pretty much seeing a reduction in all perceived rate cuts in the following 12 months. Prior to FOMC, in the prior month or so, this figure here in July was actually quite negative. We saw this go down to about negative 90, implying that there was a 90% chance, or at least an 80+% chance of one rate cut in the first half or so of 2023. That is now gone. So now we are just seeing pretty much all hikes, besides this one little blip here in June. But remember, anything 12 months plus is unpredictable. So as time goes on, these last two figures will become more and more accurate, so on and so forth for all of these figures as well. Time will basically sharpen the probabilities this far out. Next meeting, we're looking at 2 and pretty much 85% chance of 75 basis points is what we're looking at for November right now. We'll see how that progresses. But then in December, we're looking at 100% chance right now of 50 basis points. So we'll see how this progresses. But right now, we're looking at 125 basis points of 150 basis points of implied. No, I'm sorry, I apologize. It's 125 basis points of implied market rate hikes through the Fed funds futures, and this is in line with what Powell said in his statement. So he said they're seeing anywhere between 100 and 125 basis points of rate hikes into the end of the year. So let's go over Powell's statement real quick. But before we do that, this is the current forward curve. As you can see, the terminal is now 473 basis points. Before the Fed meeting, we were actually sitting just at 400. And then a few weeks before that, we were sitting at like 385, 390. So terminals are up huge in the last month or so. Important to watch this as we progress, because this is just indicating that more and more hikes are being priced in.
Essentially, the market's pricing in rate hikes until 473 basis points and then keeping it there. The market's not expecting any cuts. And that's exactly what the Fed's been saying.
Right.
They're basically doing exactly what they've been saying. There's no reason to fight the Fed. They're going to raise rates and they're going to keep it there for a long time. The market's not expecting them to cut rates anytime soon.
Yeah.
We might stay at 470 basis points. If that truly is the terminal, we might stay there for all of 2023.
Very possible. And let's go over the Fed funds rate and wrap up with the FOMC comments, and we will go into the next part of the podcast. So the effective federal funds rate via TradingView isn't updated properly. It's because there's a lag. So I plotted the current value as the dotted orange line. This is where we are right now, 308 basis points. The terminal is 473 basis points. So as you can see here, the terminal is just under the 2007 era peak. So have been slowly grinding up to this point. So rates are expected to peak or top out just under where they were at the time right before the great financial crisis in 2008. Now, let's go over the comments from the Fed, and this will help give us a better understanding of what we should expect to see, at least in the short term here from the Fed. So, opening, they said that the committee was strongly committed to returning inflation to its 2% target. Again, this is just reiterating that they are going to stick to their guns. This idea of a Fed pivot is horseshit. Now, we have restoring price stability will likely require maintaining a restrictive policy stance for some time. What they're telling you, long story short, is that they are going to keep policy restrictive until inflation is at their target. Meaning, if they see CPI go from 8 to 6, it's not going to give them the green light to do a pivot. Okay, they want to see inflation truly come under control. Now, they said that reducing inflation is likely to require a sustained period of below trend growth. What they're telling you is that they don't give a shit about the market. Okay, they understand that it's going to hurt the market, and they're going to continue to tighten regardless of what the market does. That's in layman's terms, but obviously they can't say that, right? They have to be very creative with the way they say things, because they're not going to intentionally crash the markets. But they're telling you that if the market declines, they're not going to. That's not a reason for them to initiate a pivot unless inflation is declining as well. Now, another line from them was the housing market probably has to go through a correction. Words from Powell. Now, he also stated that selling MBS is not something we're considering and not expecting to consider in the short term. The reason why I think that this is important is, for those that don't know, the Fed is holding about $2.7 trillion worth of MBS, okay, mortgage-backed securities. That's almost 31% of the Fed's balance sheet. So if they start selling MBSs, they're going to obviously reduce a big portion of the Fed's balance sheet. In turn, they are going to affect mortgage-backed securities, which is in turn the housing market. So the Fed has made it clear that they're not going to really touch the MBS market just yet. They're going to just continue with their balance sheet roll-off. Now, this is where they say, we are continuing the process of significantly reducing the size of our balance sheet. For those that don't know, the balance sheet is down $132 billion in 5 months.
Which is not significant at all.
It is down 1.48% off its all-time highs. So when you hear these words, significantly reducing the balance sheet, you have to read between the lines. Obviously, we know that they're not going to start unwinding the balance sheet, because what we do know is that the balance sheet is a primary liquidity driver, right? If you look at we've done a lot of tweeting, a lot of messaging about VIX and the balance sheet. Balance sheet starts declining, VIX starts exploding, despite rate rises. I think it was in like 2017. We just put a tweet up. Rates were rising for quite some time prior to the balance sheet rolling off. And it was only when the balance sheet started rolling off that we really started seeing VIX come to life. So it's very important that we pay attention to what they're doing with the balance sheet. And saying that they're going to significantly reduce the balance sheet is, you have to read between the lines in the sense of, okay, are they implying that more is to come? Well, they already said that MBS is not going to be touched in the short term. So I read that as they're overhyping something, that, they're basically exacerbating something that's, it's bullshit. It's not significant, but they're going to say it is. I really don't see them doing anything that crazy just yet. I think that they're saving the balance sheet reductions as a last stab at inflation. Meaning, if they can't get inflation under control with higher rates, then comes the balance sheet, and that's gonna fuck some shit up. But that's their
it's gonna
that's their
take
suicide pill.
liquidity out
Yeah,
even worse than what it is now.
Yeah, that's their suicide pill. That's like, okay, that's like the nuke. That's their nuke. Well, if they can't fix inflation, start unloading the balance sheet, they'll fix inflation real quick.
And they're gonna collapse everything in the process.
Yeah, obviously that's why they're not doing it. They don't want to do it, but that's pretty much the sum up from the Fed. So let's go into we had some people ask us, and um, we obviously want to make it clear with what our strategy is, right?
Yeah.
What is our strategy?
We want to
What
make
is our
sure everyone understands exactly what we do because,
right?
we were looking at it and we actually don't have just a bare bones. I mean, we have it in the Discord typed out, but we don't have like a bare bones start to finish A to Z explanation of exactly what we do and what our strategy is.
Right.
So, we're going to talk about that right now.
So let's start with what is our strategy, and I think the simplest way to simplify our strategy is with strat. The word strat: system, a theory, realism, allocations, and then trends. And we're going to go through each one of these quickly, sum it all up, tie it all together, and then from there, you'll get a better understanding of what and how we operate. What we do, I mean, and how we operate. So let's start with the system. Our fundamental stance is derived from what the system is telling us. So our theories, our allocations, everything starts with the system. Okay.
Yeah, system is the bare bones. That's our bread
Yep.
and butter.
Right.
Um, it's pretty amazing actually. You guys probably don't even realize it. You haven't known us for long enough, but in time you will realize the system is just unparalleled. No one has anything like what we have.
Right. And that puts us in a position to make sure that it gives us basically an unfair advantage in a certain way. The only the downside to that unfair advantage is that you guys are going to have to progressively learn as we go along. There's no way we can unload everything to you and make it believable. You have to see it in real time, and that's really where our stance comes. Because, like I said this a couple of weeks ago. I can show you any type of data point of this is what it does, and if you didn't see it happen in real time, you're going to doubt it. So I stand in the train of thought that real experiences are better than something I can put on a spreadsheet for you. And I can put it on a spreadsheet, but I choose not to because this is a journey for Market Radar and for you and for anyone that's learning and new. Everything step by step, base by base, base by base. We're not making wild accusations that we cannot prove in real time. And that's what I believe giving you a statistical backtest would do. It would be making a wild accusation that won't be backed up for some time.
Yeah.
Or even, I shouldn't even use the word backtest. I should use giving you like real portfolio results is not something that it's more of of an unclaimed statement that you will only be able to see with due time. So I'm better off just showing you in due time.
Yeah.
And that's really how I want to take this approach. Now, the system is the starting point. It's the first thing on the page. If we're looking at what's going on, we have to figure out where we are in the cycle. Now, from the system, we can develop all sorts of theories, right? For example, in deflation, when really the economy's shitting the bed, everything's falling, people are scared, right? Credit spreads are widening, it's risk off, quality's deteriorating, markets going down constantly. That's when we understand that, that's when we can create a theory. Same thing with stagflation, right? We've been saying for months now, CPI inflation is sticky. Everyone's saying fade, buy bonds, fade the CPI, Fed's going to pivot, right? But that's against even what the system's saying. But let's go into what how we get our theories. So, long story short, the system is going to tell us the direction. It's not going to give us the terrain or the problems we're going to encounter. That's why if we get the direction, we can develop a theory, right? Now, the theory of whatever the system is telling us can be broad. In the instance of deflation, the world falling apart, I can come up with a million theories of why, for example, the market's going to go to zero. The market's never going to see all-time highs for 20 years. You see this shit on Twitter all the time. You see people blowing smoke out their ass about things that never really come to fruition. Like, the big thing during COVID was the Dow was going to go under 10,000, right? Like that was a huge thing. Now, did it get low? Yeah. And the whole thing was that Dow was not going to see the all-time high for, at least 5 years because of the destruction from COVID. Obviously, the Dow returned within a year back to all-time. It was crazy, right? Regardless. But the theories are what make or break how you're going to manage your money. And the theories are derived from the system. So think of system as the starting point. Now we're on to theories. The theories can go in many different directions. And that's where realism comes in. Okay. You have to be realistic. We all know that the market's not going to go up in a straight line or down in a straight line. So that's where realism comes. It kind of hones in those theories and filters out all the bullshit and brings in the, okay, these are the possible scenarios. So now from the possible scenarios, you're left with how are you going to play them? And that's the allocations. How are we going to position ourselves? Is stagflation, just because we're in stagflation, right? And we have our theory that CPI is going to stay sticky. Realistically, it's starting to roll over, so we have to pay attention. Crude could have some downside, right? But we go back up the chain. We're still in stagflation. CPI remains sticky. Crude is bearish trend. CPI could roll over, but the allocation doesn't make sense. And in turn, if you did say, okay, the allocation would make sense, you still have to go to the last component, which is the DDAP trend. So that double checks the allocation. They're like brother and sister. So one says this, the other says that.
It's important to have these multiple levels to a strategy to avoid yourself from getting caught into traps, because there will be traps. We've seen it recently with bonds. We saw that rally in ZN. A lot of people got trapped into that. They thought deflation was coming. And having these multiple facets, multiple things you're looking at. We had our theory, which saved us from that. We had our theory. We're looking at real yields. We're looking at multiple areas of the market that plays into the stagflation regime that we're seeing. And that helped us stay out of that carnage. But then we also have the trend as well, which reinforced that. ZN was bearish trend throughout that entire move. That helped reinforce it as well. But if DDAP, for whatever reason, failed us and it was bullish trend, we still wouldn't have gotten caught in that, because we still had our overarching theory. We're in stagflation. We had the real yield theory. We're looking at gold. We're looking at all these multiple different things that are saying the opposite of what was happening. So that's how we knew it was purely price action. While everyone's running around calling deflation, telling everyone to buy bonds, we didn't get trapped in that. And that's the importance of having multiple levels to a strategy and developing a strong theory. Having a theory is a huge part of it.
Right. And I think, you know what? Let's break down this acronym STRAT into something so that it's really understandable. I'm assuming there's some people that are listening to this that can't see the screen, so I'm not going to annotate anything on the screen. In your head, I want you to think of the word STRAT written vertically. And then I want you to take the S by itself and then the TR for the next two letter, or the next second and third letter, and put them next to each other. And then AT, I want you to put them next to each other. So the system's by itself, theory and realism check each other out, and then allocations and trends check each other out. When I say check each other out, I mean balance each other out. So you can't get through the acronym without at least two checks and balances. So you're never going to get to the end of an allocation without being double checked twice, or basically without being double checked twice without being double checked, right? So you can't go down this acronym without double checking your theory, or I should say your end result, right?
Yeah.
And that's the most important part, because like you just said, stagflation, right? Normally is a great precursor for bonds. Buy the fucking bond dip at that point. Get loaded, get ready to go. We're going to the moon, right? But bonds have been bearish trend all year since 2020. So when we see stagflation and bearish bonds, we get what we would call a non-directional regime, because equities are risk off, right? Equities are bearish trend. Equities are risk off, but now they're also bearish trend, so they're really not a play. There are periods of time where they'll stay bullish trend, and you can it's murky, but textbook is risk off, bearish trend, stay away. Bonds are supposed to be risk on, but they're bearish trend. And if we go down our theory, we double check it with realism, we find out that bonds are an allocation, but then we realize, you know what? No, it's not. The trend doesn't match up. And so far, we've saved ourselves multiple puke sessions of getting just gaped. And I think that this is very important, because most people don't really know how we look at the market. And on top of that, they probably don't understand the process that goes through my head every day. Now, we're going to finish this podcast off with how I actually look at the market from a security by security level, or
Well,
component by
so
component
this is
level.
essentially you're going to be talking about how you develop a theory, how you make observations to back
Yep.
up a theory.
Right. Exactly. So for those that don't know, this is linked in the Discord, the macro watch list. This is all of the components that I look at every day and that we use to build a theory. Everything's on here.
Yeah.
Crypto, everything from crypto to commodities to real yields to bonds to vol to everything,
And
futures.
and building a theory is not easy. We hop on
No.
calls pretty much every day talking about a theory and building upon it. This
Right.
our whole theory with the real yields and gold and everything we tweet about, that comes from days and days and days of constant observations that we make, and we discuss the theory, and we test it. We throw things out. Okay, what if this would happen? Like, how does that change the theory? We're always on top of it, and that's
I,
very important to
yeah.
do.
I think that's a really good point to make because a lot of you guys that are listening to this are independent. You're in the chat room, you have each other to talk to, but you're developing theories independently. So there's no way for you to double check your theory or I should say alter test your theory if that makes sense. You can't use an alternative mind to look at your theory and say, this might not make sense because of A, B, and C.
Yeah, and you get trapped in biases in that
Right.
situation as well.
And that's why that's our advantage to you guys. You're getting the acronym, right? So the way that we look at theories from a base level, but it's also double tested between two different people that know and understand the system that are looking at that acronym and making the same and having to come to the same conclusions. So think of it like the theory's double checked, right? Throughout it's double checked by the time you get to the bottom of the acronym strat. But each of us are coming up with that and we each have our own double check theory, but they're both lining up. So it's almost like it's quadruple checked if you think about it.
Yeah,
We
and
both are seeing the same things and we're both coming to the same conclusions after both double checking them.
this is the importance of the Discord as well. We want to build a community where we all like everyone in there knows so much about macro that we can really have in-depth conversations and think of the theories way before anyone else can. And
Right.
that's
And
when money's made.
there's some Twitter groups out there that are like trying to dedicate like a certain scope of who does what. Like, oh, we'll have this person's an expert here, this person's an expert there. Um, in reality, though, for like we'll use this as an example. When we get to deflation, what good is an energy expert?
Yeah.
Right? Like what good or when we get to deflation, what good is a commodities expert?
Yeah. Well,
The
the thing
system
is too is
is
like um when people think of macro,
yeah,
I mean when normies think of macro,
right.
it's boring. It's boring. It's a lot of work, and there's kind of this misconception that like it's slow. You see these day traders getting their daily options, and like they're making 300-400% in a day and shit. We make gains. Like I don't want to sound cocky or anything, but like we're here to make money. Like we take risks. We're not macro guys that does a 60-40 portfolio. We're in like little mutual funds and shit, getting 2% a year. When we go in, we go in. And that's why we have such a foolproof process with all this double checking, having the theory, having DDAP, everything double checking each other. Because when we go in with confidence because we
Yeah.
know we're right.
Right.
So that's the
Huge.
importance of having the
Huge.
strategy that we have. We need to have that confidence. If we don't develop a theory, if we only have the regime model, yeah, it's good, it's powerful, but we're never going to be able to put real money into a play based off of a model that, just an arbitrary model.
But like
We
this,
have
if
to
all you
have
saw
multiple
if all you
facets to have that confidence to put money into what we do.
yeah, if all you saw was this or even this, like you wouldn't have an idea what to do. Right?
Yeah,
If all
exactly.
you if all you saw was these outperformers, underperformers, whatever, right? Like here, for example, you could see what's outperforming. If you know it's expansion, what you're gonna just long this, but you're not understanding that each one of these components has its own trend and direction. So that's what's important about the double checking process via DDAP and just the whole scope. Now, I do want to run through quickly how I do this with the macro watch list, right? We have the macro watch list every day on Twitter. I'm tweeting in the morning about the dollar, its main three components, and occasionally gold. Reason I'm doing that is the dollar is the foundation of the financial system. So I give the DDAP chart of the dollar away every day for free for everyone on Twitter, because it is so important that we all know where the dollar is, that there's no reason anyone has to pay for that. It's almost like, okay, this is water. Without this, you're not living. So like there's no point in me
Yeah,
explaining anything else to you.
we gave
Yeah.
it the basic necessities.
Right. Yeah. So the dollar is a basic necessity. We'll pull up the dollar quickly. Now, the dollar, obviously, whatever it is, where we said to go along, what we said it's been doing. Obviously, DDAP alone has been saying this thing has been bullish trend since June or July of 2021. So anyone shorting the dollar, grave mistake. That's on their terms, though. Long story short, though, I look at the dollar. I say, where is liquidity going? We have too many podcasts about dollar and market liquidity. You can go watch them. You can go on our Twitter. The dollar is basically an inverse liquidity indicator. The higher it goes, the worse liquidity gets. So if I'm watching liquidity and I'm seeing the dollar rise, okay, I'm starting my theory. My theory always starts with, what's the dollar doing? Where's the dollar going? What's the trend? So on and so forth within the regime. From there, I'll go through all the symbols. I'll just tick through them in the morning. I'll see where real yields are on a traded basis. Obviously, this is not live 100%. The reason I use this over the terminal is to get into the terminal, it's a pain in the ass. I'm usually on the go in the morning, so I can go through this within 10, 15 minutes. By the time I open my terminal, load up my spreadsheets, it's, I'm fucking 45 minutes in. So I just go through this quickly in the morning. At night when I sit down and I can really gather information from the terminal, that I spend some time and really understand certain things that happen during the day. But that is not as much of a necessity as it is to understand these two things: the regime and the trend. That's it. You can build a lot. You can build a whole foundation and investment process off of regime and trend. You don't need to be a quant guy. You don't need to be any of this crazy shit. The system's already created for you, for me, right? So we have the values there. We have the DDAP thing, which everyone who is a member has this live on their charts. So you don't need me to tell you things. You don't need me to release a report to tell you what's going on with DDAP. Obviously, the system isn't going to update multiple times a day, so one value is fine. You get that in the morning reports, and you'll be able to see, okay, the system is this, the trend is this. I can build my theories as follows. And obviously, we will portray our theories constantly, because we believe that our theories and our objectives aligned with the system will help us be the most profitable. Now, you can do as you please. None of it, this is investment advice. But again, following our steps, doing what we're doing, we hope that visually and educationally, you could see that this is not a bunch of bullshit. And I think that's where we're going to leave it off today.
Yeah, I think that's good. I hope that helps you guys understand a little bit of how we do things, what our process is. It's unfortunately, the whole theory aspect of it does take skill and experience, but that's what we're here for. That's why there's the Discord. We're there to answer questions, and you'll get to our level eventually.
Yeah, always ask questions. But you know what? Another thing, you know what? It's not so much about getting to our level that even matters, to be honest with you. That's all. It's all egotistical, right? Oh, I want to know. I want to know. I want to be at the highest level possible. Money talks and bullshit walks. Okay.
Yeah, that's true. You got people like, you got people like Alf. He's a smart guy. He knows what he's talking about. He's a macro guy. Like he probably knows way more about macro than we do. But right. Does he make money? I mean, like he's been saying buy bonds for the last 6 months. Probably not.
Right.
So it's not about knowing everything. At the end of the day, we're here to make money, and it doesn't matter how much work we put into it. Some people don't put any work into it and make a shit ton of money.
Yeah.
So you won't know anything. You won't know everything.
There's no
Right.
way you'll ever know everything. You just got to know what matters.
That's a great way to end it. I think that's where we should leave it off. Thank you guys for listening. If you have any questions, feel free to go to our Twitter at the Market Radar or our website at www.market-radar.com.